Valentin, we talked about fallout, feedback loops. We've talked about the amount of reputational, political capital that has been spent in China. The FX reserves, you pointed out. How significant is that?
Well, if you look at the foreign ownership of Chinese stocks, they're about 100 billion or so dollars of foreign ownership. Need not look as significant compared to the $4 trillion of dollar or FX reserves that the Chinese are having. But it's worth highlighting that what we are seeing at the moment happening as well is that the Chinese corporations are actually also repaying their dollar-denominated debt, which amounts to $1 trillion. So an acceleration of that sell-off really could have triggered further outflows from the equity markets, which would have coincided with repayment of forex debt, which would have effectively led to further significant reduction in FX reserves. And why is that important? It is important because the Chinese, obviously, together with other sovereign currency managers, have evolved into quite a significant player in the global bond markets, stock markets by implications, currency markets. And if anything, falling FX reserves could mean that there could be a structural imbalance between supply and demand, if you wish, in the bond markets, obviously in the stock markets. And if you look at the risk premium, the term premium in the bond markets, but also risk premium in the stock markets, these do not seem to reflect just yet such a potential imbalance. So if anything, down the road, if such uncertain or bout of uncertainty were to strike again, chances are that the consequences could be quite significant. Ultimately, the end result could be tightening in global monetary conditions, on the back of that repricing in the term premium risk, if you wish, or also risk premium in the equity markets, and ultimately could lead to a broader risk-off.
The damage that has been done already, Patrik, the feedback loop directly from an equity market sell-off into corporate balance sheets, you've been looking at that. What is the damage that has been done?
We don't know the numbers, but you know, we all know that there are plenty of companies in China that like to play the stock market rather than focusing on the operating business, and doing that with borrowed monies and securing borrowing on share prices. So, you know, there is a direct feedback loop into corporate health that doesn't exist in most other markets. So normally you can have a stock market take a dive and it doesn't really affect the balance sheets of companies. In China, the suspicion is that that will be a factor there. Quite, you know, on top of all the other confidence effects, consumer confidence will certainly take a knock on the back of that, even though there's not a lot of household wealth in the stock market. Certainly, you know, they read the newspapers too, that will take a hit. To actually say, even if the authorities manage, and, you know, they have a lot of firepower, even if they manage to pump this up again, to say, well, actually, it's not going to leave any damage behind, I think it's pretty optimistic, to say the least.
We call it a market with inverted commas because, of course, half of it isn't trading, and everyone will love the headline, the biggest two-day pop since 2008. But really, we don't know what this market would have done if the other half was trading. We don't know what this market would have done if they hadn't told the biggest stockholders they weren't allowed to sell. We don't know what this market would have done if there wasn't such a sustained, active propaganda effort through the state media to get people to buy shares again. What we can ask, though, is the question whether this will be a sustained bout of risk aversion in the months ahead. You can have a two-day pop, but beyond that...
Well, I think in terms of setup, I think that it does highlight that potential lingering divergence, structural imbalance between supply and demand of global assets. It is the case that global currency reserve currency managers evolved into significant asset, effectively significant players globally. And if anything, if they were running out of money to buy stocks and bonds, that could indeed trigger repricing down the road. And again, more bouts of uncertainty like this actually could effectively contribute to that development. On the top of that, right, on the top of that, it is the case that what they have to deal with is a drop in export revenues on the back of slowing global trade. Commodity exporters have to deal with drop in export revenues on the back of lower commodity prices. They have to deal with growing fiscal deficits, and that could be a recipe for disaster, especially if it results in further significant decline in global FX reserves.
It could be a political disaster for the Communist Party as well when we start talking about the consequences to social stability. And I want to wrap things up with you, Patrik, and just think about the reputational issues going forward. A month ago, around about a month ago, we're sitting here talking about inclusion in MSCI indexes. We're talking about Chinese authorities going around to big, large stock investors saying invest into China. How much damage has been done, long-term damage, to the reputation, to the pro-market credibility of the Communist Party as we go forward?
Well, I'll just refer you to the headline you had, China Chaos, right? So clearly there's a lot of damage that has been done. The inclusion into the MSCI indices has to be, questioned now. There was a lot of statements that we want to give markets more importance. We didn't realise that that's what they meant. So, yeah, there's a lot of damage done.
Final point, Valentin?
Well, obviously, the SDR basket membership that China is aspiring really potentially to come mid-October could be threatened as well. Ultimately, if you want to create a reserve currency asset, if you want to have a reserve currency, you have to guarantee some financial stability. You have to want people to buy your assets, if you wish. And the fact that you're intervening in the market just like that, obviously, for all the good reasons, is not helping. So presumably, there could be a reputational damage, which could mean that before long, they may have to reconsider the speed with capital account liberalization and indeed their progress towards adopting a reserve currency.
A crazy week in China. Gentlemen, thank you very much for joining us this morning. Thank you to Valentin Marinov of Credit Agricole and Patrik Schowitz of JPMorgan Asset Management.